In this video, I want to explain the use or how to use the exponential moving average to determine the underlying trend for a market. I utilize this 15-week and 40-week EMA, and as you can see, as depicted in this particular chart here. As I've indicated here, a intermediate term buy for the market is given when this 15-week exponential moving average is greater than a 40-week exponential moving average, and a sell would be generated when a 15-week exponential moving average is less than a 40-week exponential moving average. Now you might say, exponential moving average, why not use a simple moving average? Well, think of it this way. In a simple moving average, let's assume we take 1, 2, 3, 4, 5. Take the average, the sum is 15, we divide it by 5, and we come up with 3. Well, when you use a simple moving average, we are weighting each period day as the same. Well, with an exponential moving average, 1, 2, 3, 4, 5, we are putting more weight on the latest data point, which seems to make perfect sense in the financial world, just due to the fact that today, right, should be more relevant than, we'll say, maybe 5 days ago or 15 days ago, 15 weeks ago. That's why the emphasis is placed on exponential. Just the simple fact that today we should have more current information about the market or about, say, a company that we are thinking about investing in than the information about that company we had, we'll say, 15 weeks ago. That's why I utilize the exponential moving average to determine my signals. So you can see here, this is what you have up on your on Blackboard, I should say. And I just want to highlight a couple of things. This goes back to really the mid-90s, and it goes through basically on into 2013. As you can see, in other words, the 15-week moving average is yellow, and the 40-week average is blue. And so you can see here that, in other words, a buy was generated here in 95 based upon the 15 EMA was greater than the 40. And you can see that really from the, we'll say, 95 all the way up until we hit, of course, the dot-com debacle up here in the latter part of 2000 was a tremendous buy. Again, this is on the S&P 500. And then we had to sell due to the fact that, okay, EMA, the 15 was less than the 40, so that would generate a sell signal, and that would be indicative of, okay, now what do I do? Okay, I'm in the market. I've had this major run-up in the market, as you can see from the standpoint of around 500 all the way to above 1,400. And, okay, now's the time to really move from equities, stocks, on into, we'll say, a savings account. And that's how I basically utilize this. I'm a great proponent of exchange-traded funds. As you can see from the standpoint of reading a document for this particular week, it would be like you can trade the market, i.e. I can trade the Dow, I can trade the S&P, and of course I can be in stocks. So when the sell signal is given, 15 is less than the 40, I'll move out of that ETF and I'll move into a money market fund. And you can see that's not bad at all. Once again, a tremendous decline from about this area, we'll say 1,400. And of course, we got a buy signal in here right about, the middle of 2003. And sure enough, in other words, 15 went above the 40 all the way up until, of course, our so-called subprime debacle in the mortgage area here in about 2008. Matter of fact, it was January of 2008, and we would have been out of that major decline because once again got a sell signal. The 15 went below the 40, and we would have got back in when here. That was equated to approximately the August, early part of September 2009. So again, that's how I utilize exponential moving averages, which is an intermediate term market indicator. That means I'm not getting in on a daily basis or a weekly basis. It's longer term in nature, and this is just a good way to invest. It's a good way, especially for those of you that might have a 401k, your retirement accounts, to get established in the long-term trend of the market, to be in the market, and of course there's a time to be out of the market. Not everything goes up forever. So really that's how I utilize exponential moving averages to make intermediate term market signals of being in the market, 15 above 40, being out of the market when 15 is less than